with the CPI yesterday coming higher than the forecast, as we actually have been foreseeing. Fed is being placed here on a very slippery road. They are normally supposed to speak of the hikes in order to prevent those percolating inflation, but they are not a hedge fund. They can just change their stance from day one to day two, so they stuck in the old narrative of the cuts. And market is still pricing in one more cut in the upcoming Federal Reserve meeting. So what does that mean for the markets and why I believe the risk is building? What are my positions here? Let's go. Good morning, good afternoon, everyone. My name is Russ. Today is Friday, and with that's quite an important macro update since the CPI print yesterday has been said came higher than expectation. It's just further on confirming my macroeconomical concerns of the regime changing here. I am quite confident right now that this is not anymore looking like the Goldilocks, and that is why I am rebalancing more and more my portfolio towards the stagflation mode. For people following me in the Telegram alert group, you already know what stagflation is. Obviously, for those who have not heard this term comes from a combination of two words, which is obviously stagnation in terms of the output of production and inflation, which is pretty much driven by the central bank policies, which tries to stimulate the economy in those turmoil period, but causing further inflation. And as I said, as in the beginning of this video, you have to understand that Federal Reserve is the very slow and sloppy machine. And once they have committed via their dot plot, via their communication, via their overall political stance, because a lot of things that Federal Reserve is doing are extremely political. They cannot just, pivot in the middle of the road like an efficient hedge fund would do. As soon as they understand that something is changing, or I would personally do, as soon as I understand something is changing, I go and I rebalance my portfolio in a matter of hours. Federal Reserve cannot do that. They would now keep propelling the same kind of communication for months and months until it's too late. And what I'm personally afraid here is that further and longer they're going to be speaking about the cuts. And right now, if you're going to go to the Fed Watch tool, we still see that, for our 7th of November meeting, nothing has changed. If I'm going to hear and see the yellow column on the left, what is now versus what was 1 day ago prior to the CPI print, actually, the same situation. Like market is kind of pointing to the 25 basis point cut. And I don't think this is obviously anyhow sane here. Let's put it mildly. I think that the 50 basis points cut was quite insane, and further on cuts when inflation is not able to be tamed are quite insane, so to say. And what does that mean? It means that if inflation, with all the adjusted methodology, with all the tricks and whatever new methods are used to measure inflation, is still gonna come in sticky now, 6 months from now, that at some point Fed is going to be obliged to start speaking about the hikes. And now think of that, be ahead of the curve. If the entire market is still pricing in cuts without understanding that the discussion of hikes is inevitable in this environment, then how painful it will be for the entire market to come to this realization. And this is why I'm starting to build my shorts on equities, not on commodities. Let's have a quick look what performs good in this environment. First of all, you need to understand that we are having 4 major environments. In order to visualize, let's look on this picture here. On top, you have economical growth or GDP growth for simplicity's sake, right? And on the horizontal axis, you have inflation. So we have basically 4 regimes. The quadrant number 2, when the economical growth and inflation are both positive. We have reflation. We have Goldilocks when inflation is fully combated, is within 2%, around 2%, not too small, not too high. And we have an economical growth, a so-called Goldilocks scenario. We discussed it multiple times during my videos, and that's what many people are calling soft landing. We have also a negative economical growth in terms of the real growth, of course, adjusted to inflation. Of course, because if you just print infinite amount of money and number go up, as we say, and iPhone prices are going up, and eggs are 40% more expensive. That also contributes to the high number, but that's not the real economical growth. The real GDP growth is negative in this case, but inflation is not combated. This is stagflation. This is quadrant number 3, and I think this is the most prominent environment that it starts to build up from here. And of course, last but not least, we have this environment that, for example, Katie Wood and other fund managers and macroeconomists are speaking about. That's very often related to disruptive innovation and the fact that inflation is combated because there are basically more goods, more output that can be reached through this breakthrough innovation, through robotics, through automation, and that can cause a deflation, which is also quite tricky. So we need to be aware of those scenarios too. But right now we are, in my opinion, moving towards this quadrant number 3, the bottom right quadrant, and the precious metal such as gold and other commodities are extremely fruitful in this environment. And on top of those, you see they are mentioning rates and what they're saying to avoid leverage and lower grade credit, and so on and so forth. Avoid the debt, avoid also equities, right? But then you're gonna ask me, oh, Russ, but like to which degree I need to be in rates, to which degree I need to be in commodities? So I found those average real inflation adjusted year-on-year total return table, and it takes into account 50 years of data since 1973. And here we see that the stagflation regime that I was mentioning right now is extremely favoring, first of all, gold and other commodities. Of course, they consider a very large basket of commodities here. They will take into account lumber and potash and orange juice and pork belly and whatnot, everything that actually qualifies as commodity. And of course, not all of those commodities are interesting to us. We are much more focused on PM or PGM, like precious metal basket. And on top of that, of course, for people following my Telegram alert group, you know that I am getting bullish on lithium, I'm getting bullish on potash, on molybdenum, and so on. So if you have to, decompose those top 3 that are performing well, I would say that certain asset classes, such as silver, for example, not a surprise, obviously, for people who follow me, you know how bullish I am on silver, and you know why, fundamentally. I believe that we're going to have significantly higher returns in silver a year from now. I would believe that silver can go to the area of 42 in a matter of 3 to 4 months, and towards late 40s within 1 year. So late 40s from here. Let's maybe go on the chart, not to make it too boring. And I actually put just this horizontal red line around 30. I think as soon as we hold 30, I am, by the way, on a weekly time frame, just to give you a little bit more of a longer term perspective. Yeah, 60% from here in a matter of a year, I consider this is realistic. This is not an overstretched target, and the reason for that target would just simply lie in the gold to silver chart, because gold made it move, and in my opinion, silver just has to come to those levels that I've been showcasing prior. Those levels are not in the chart, those levels are fundamental, and those levels are driven by silver demand. If you missed those videos, please don't hesitate to go and rewatch my first silver video here on DataDash. I'm gonna put the link in the description down below. This is an important one, and it actually provides you in half an hour the entire silver thesis, and this is why we have been performing, our portfolios have been performing so well, just being, in a way, curious and exposed to this asset class. And looking at the charts, to give you an idea, I am actually getting hedge short exposure here. I'm getting short exposure on S&P 500 as an ETF, and realistically, I would say I would follow here to target something around 540 and 520 to be a little bit more conservative. And of course, give yourself a bit of a room to add up. I don't want to have too tight of a stop loss, because PC data coming in and multiple opportunities can be used for liquidity grabs. But taking into account that oil is spiking, taking into account all the geopolitical risks, and you know what? I mentioned multiple times how the increase in oil is actually also very badly perceived as an inflation risk for the market, right? So this is a bullish chart. This is a very bullish chart on oil. If you don't see that, please bring the diagonal line. But overall, you see that multiple divergences are building on these lower lows, and then market structure break you have here. and now we are just retesting the breakout line. So of course, with oil spiking here, I mentioned I personally hold a tiny position in Occidental Petroleum as well as in the one egg oil service ETF because they're lagging. You remember, guys, we already made money with OIH. I'm looking forward to do it again as soon as oil is up. I think that's a realistic 20%. Of course, don't overexpose there. If you really want to have a good hedge, I think XPXS is providing much better opportunity, which is the direction daily S&P 500 bear 3x leverage ETF, right? You see those kind of ETFs you should never hold for more than needed. You only open them for a week or two maximum, and the reason for that is the backwardation. Is a backwardation that definitely affects the entire price of this ETF. So please, I highlight it here. Don't buy it here at 6 expecting it to come back where it's supposed to be. It's not ever gonna come back where it's supposed to be, but it's a good hedge, especially if you have a long equity exposure. So XPXS is your another opportunity to hedge here. Me personally, I opened a short position in Meta. I start to build my Meta position. My average entry price is around 572. So far, $250,000 market size. I'm happy to increase it to $1 million. So I'm gonna have a 7-digit position against my best friend Suk, because I believe Meta can definitely run higher here. Let's look at the chart. Right, I am a little bit underwater, but that's okay because I'm DCA dollar cost averaging into my position, and I would say that those poor lows are not safe. I would like to target those lows here and here, and more conservatively here. So I am happy to DCA all the way to 600, but even if Meta is going to $1,000 in 5 years from now, with all the inflation, and stocks are being inflated too. Obviously, Meta is making their money in a B2B, B2C world, and they can just, of course, adjust, for example, the monthly verification price from $10, $15 to $100, 20 years from now, if we really have like a prolonged cycle of inflation. And obviously, it's going to contribute to their numbers positively, and that way stock is also possible to be at 4 digits, but I first want it lower, and I'm also happy to increase my exposure all the way here to 600. I'm happy to add in this zone, and I'm also happy to cut if I'm wrong, and there is also just a prolonged squeeze, short squeeze from here. I am always thinking in terms of probabilities, but so far it is favoring the downside move for me. Same Apple. I am getting short on Apple. I'm just starting to build my short. I had a short position here. You remember also, well, that's why I keep sometimes those trades on the chart. We went long on Apple here, and that was actually a great move, just following the extension in our range. It was almost 18% move. It's a very good move, and then we accepted above this range, and we have another 20% move. So it's almost 40% on Apple. Amazing. But now I'm leaning short, which is okay. So you people are saying, oh, but did you flip your bias? No, I'm not flipping my bias. I am just readjusting according to where the macroeconomical situation and the price chart is giving me the opportunity. So right now I am happy to add into my Apple position in all the zones between 230, 240, because the all-time high is 237.23. So maybe we do like a quick liquidity grab here, and maybe we actually liquidate all those shorts because people went too short too early. It's also probable to me that all that quick extension, those short, should not stay in. If Apple actually has to go lower, we're gonna travel without those passengers. So I am fine to add also at 240. And then if you start accepting above 240 and price stays there for several consecutive days, as you know from auction market theory, it means there is acceptance happening beyond that value, and then I would cut. But with all that said, my short position, so my average entry is going to be somewhere here, and my invalidation point on my stop loss, manual stop loss, I'm not going to put any stop loss in the brokerage account, but I'm going to cut it manually. And I'm happy also to get the retest, tap into all this crazy fair value gap. So much of transaction have been happening here in a disbalanced market. So for you to go long here, market maker wants short, market maker wants to recap his position. It's very normal that we come back and revisit $200 for Apple. And this is my risk to reward. It's 4.5 to 1. It's a very good trade, and that's why I'm taking it. Nothing personal against Apple, just simple math. Now, last but not least, super important, coming to silver here. First of all, we noted this relative strength of silver junior miners versus silver, and I told you on Wednesday, look at that as your signal for reversal. And then obviously we start building our leap or our long-term call position in silver. Just to confirm for anyone who is not in my Telegram group, guys, we've been printing. First of all, I opened this 200,000 position at Palladium. Right now it's around 20,000 already in plus. Then I told you, what is the day here? What is the day here? 9th of October at 2 p.m. around the market open. I told you this is the bottom in silver. Let's see on the silver chart. That was exactly the bottom in silver. We bought the calls, those calls, depending of course on your strike price and you know, of what is their expiration date. But with silver, like 4% move, your call should be already, of course, 10 to 30, 40, 50, whatever percentages in profit. I personally recommend to not be too risky here, to use the very long-term duration calls, 2025, 2026, and you can consider them as your physical silver, because you don't need to worry if silver goes $1 up or $1 down. You know, if by the end of this year silver is towards 40, you're gonna make tremendous amount of money, life-changing amount of money. Like all these people who are telling me thank you for the wedding, thank you for the house. This is not a joke. People are really, you know, basically relocating those silver profits into something tangible and changing their lives. So don't sleep on it. And if you're not a member of the Telegram group, I recommend you subscribing, because obviously it's free. It's free as soon as you're a Nix subscriber. I can't accommodate everyone, but I guess less than $1 a day, it's nothing comparing to the value you receive. So putting the link in the description down below. I think that the bottom in silver is in. I also feel the bottom in Palladium is in. We're giving like a quick look on Palladium here. That is exactly when we entered. Guys, those entries, no one gonna give you. That was so accurate, so straight to the point. You, once again, if you doubt, you think I'm making it up, let's just go on Telegram. You see my long end Palladium here. Which day is that? It's 8th of October. It's 5 p.m. Central, UK time, GMT. It's 5 p.m. Now I'm going to the chart. And this is where we entered Palladium. This is around 1000 level. On that day, if you really want to see when the 5 p.m. was on that day, we can. Let's put like a long signal here so we can see. We entered at 5 p.m. 8th of October around 1010. I told you 972 is my stop loss, very tight. And you know what? That's probably gonna drive us to at least 1400, like to those levels here. So I'm fine to do this 10 to 1 trade, guys. Those type of trades, you shouldn't miss on those. Those are life-changing. Those are the trades to be. And last but not least, you're gonna ask me, Russ, what about crypto? Okay, we don't have much time today. We're gonna have a specially dedicated crypto review on Wednesday, because right now we still are in positions for my Telegram group subscribers, and I just wanted to give you an idea why. I told you I don't like the open interest here. We need to liquidate more open interest. We liquidate, more sustainable the up move will be. And I actually told you back in the days, a week ago, when everyone was longing at 63,000, I said, don't worry, we were at 64 back then. I said, don't worry, at least 62, we're gonna enter. And you know what? Just coming now to our coin analyze chart, I can see here that this open interest has been building up here. It was completely unsustainable. I told you the price is going down. There is certain attempts to long. Open interest is raising. I don't believe those moves, so I'm gonna wait, and I gave you the target where to wait. And moreover, I really like those spot beat yesterday. If you're going a little bit more on the LTF, lower term time frame, I told you 58 would be the point where I will get interested. We front run it by a few $100s, and what I noted here is those very nice spot beat. That's why immediately I provided to my Telegram subscribers. I said, guys, I'm going to bed right now, but I'm placing this trade. 59.7 and 57.3 will be my stop loss. We're gonna hold it for a month, and right now seeing how the funding is getting negative here, I might think that the bottom was in, at least for the period of time. And why I'm thinking so? Well, because of the yield and the XY. As I've been telling you, that can give a breather to the risk on assets. This 103 level was a great signal, because I gave it here at around 100.8, well below 100, when everyone was telling dollar goes to 90. I said, no, we're gonna have a spike, we're gonna clean out all those highs. You know, sometimes being contrarian works, sometimes not, but you need to really have your deep understanding. Just being contrarian because everyone on Twitter says something doesn't necessarily have to work. But very often it appeared that this year I've been contrarian and it worked out quite well, because I think I analyzed the wide range of a macroeconomical factor. And you remember, guys, for those who missed, the reason I've been saying those is those yields, is those 10-year yields. And you can see also this 10-year yields are giving us a tiny breather. We are not yet done. I think the fact on how macroeconomical data is coming, markets start fearing that with the inflation data raising, Fed might, cut less than market initially expected. So yields are still raising. I'd like to see the market structure break there. I'd like to see this level, acceptance below 4% on 10-year, and that would definitely give me a better trigger for the risk on assets. But so far so good. I think we already can expect a little bounce on Bitcoin here, as well as on Ethereum. Ethereum to Bitcoin chart, as I mentioned in Telegram group, are doing quite fine. Ethereum to Bitcoin itself might be that the bottom is in, because I like how it emerges. I might expect here, as I said a few weeks ago, this W formation to play, and that probably gonna give us the spike into 2800 if given. Once again, we don't have to be all the time right. We secured our entry. We entered at 2368. We can move our stop to the break-even, and we just run it from here. And if we're wrong, then there's nothing that we're gonna lose. And that's the reason why I'm telling you guys, think in terms of probabilities. Join the Telegram group. Let's make this generational wealth together. Let's have some fun. Let's learn macro. Much love. And with all that said, I wish you an amazing end of the week, and I see you next week once I'm back home. See you. Bye.